What we're going to look at today is the psychology of a drop. So what we're going to touch on is how the market, gold in particular, got to where it is, and also how that led to the drop that we saw yesterday morning. Now, there were two drops. There was one in the middle of the night. We're not really going to discuss that one too much. I'll touch on it briefly. And then there was also the flush out around about 8:30 yesterday. What we'll do in a future mental session, perhaps we'll do this next week, is actually then go and look at the order flow on that and how you would actually try and stay in that trade. So what's actually going on within that trade to allow you to stay in, to pick your points to exit, and then there was a really interesting bit of action at the lows, which I'm sure many of you saw. 04.3 should give you a clue as to what I mean. Right, so what exactly happened yesterday? How did we get to that big drop? All this comes from your mapping of the move. Now, I've talked about these kind of ideas before, how to map what's going on. And it's so important that when you're looking at any kind of trade to take on, it's not just, a trade isn't born out of just purely what just happened. The trade itself comes more from what's happened and how the market has got to the situation that it's currently in. That's the important bit. So there's two things to be thinking about when you're mapping any kind of movement. First up is your technical situation, and this is purely objective. You're not trying to put any kind of personal slant on this or spin or personal view. This is a case of being able to say to yourself, right, objectively, what has happened throughout this move? Facts that you know. How has the move developed? So is this a move that has sort of waved higher? Is this a move that has ground higher? Does it have a solid base to it as well? And that's an important question for any kind of move. The move without a solid base is like a house without a foundation. It may look impressive and may be able to get quite tall, but at a point when it starts to show signs of wobble, it will fall over easier and much more dramatically. Also, within that, order flow within the move. Now, I'm not meaning the specifics of how the market traded at every single price, but what I mean is the patterns with which the market has moved. What we've seen a lot recently in gold is spikes in the overnight session that have then pulled back, followed by a steadier bid up as the higher volume European and US session has come in. So this is starting to give you a clue that people are getting forced into this move up. Then it's a time, and this is slightly more subjective, of course, to think about the psychology of the market. Now, what I mean by this is, how are other people thinking about this move? So think about the positions that other people are going to be in. Put yourself in their shoes. Imagine yourself, now I'm talking from a day trading perspective here, but imagine taking yourself away from your own day trading perspective and desire to get the most accurate prices and take out different portions of moves to someone who's a little bit more medium to longer term. What are they going to be thinking? Are they still going to view this as a good move? Are they likely to be in and looking to profit take? Are they likely to be in and trailing stops? Or are there still more people to come into the move? This tells you about whether positions are becoming weak. Now, what I mean by weak position, this is no view as to the person executing the position or the institution executing the position. It's to do with where the position is entered. If you're entering a position here, that's quite a strong position. But you know yourself, if you've chased the move up and you're buying towards the top, you're weak. What I mean by weak is that you are not willing to hold on in a pullback, or at least not very far. So the idea of your trade getting in up here is you're expecting that this continues reasonably quickly. Whereas a stronger position from down here that has been willing to sit through some pullbacks and been on the steady part of the move isn't going to get so flustered by any kind of shorter term washing towards the top. This is where you need to start thinking about tipping points and start asking yourself, right, if I was in this position for the past week, where would I give up on this? At what point would I exit this to take my profit? Either from an exhaustion point of view, which is less able to give you a trade, or from the point of view of where would their trailing stop be? And this is where the acceleration of the move comes from. And the final thing I'd suggest as well, and this, as I say, is very subjective here, but listen to the crowd. What I mean by this is as soon as we got up around about 1800, more and more talk started coming in papers, news channels, gold's going to break the high, gold's going to break the record high at 1920. And it did. And then we start hearing gold's going to get to 2000. We had this today from Goldman Sachs, fears over dollar's reserve status as gold price rises, i.e. they are doubting whether people are going to want dollars so much now that gold is so valuable. And are people showing their willingness to own gold instead of dollars in this recent push higher? The more and more hype that seems one directional focuses everyone's mind in one direction. That creates a crowded trade. These are the trades that turn over. Now, I'm not saying that gold is at the top and this is it, game over, gold won't go higher. This is where we currently are on a daily, this is over the past week. I'm not saying this is the end of move. What I'm saying is short term, you can get a washout based on the way people have been trading this. So, this is the recent move that we've seen in gold. This is from the beginning of April, end of March. Steady sideways action, we get up to around about 1800. And it spent a few weeks looking like it's going to break. And finally, last week, we break. We get a steady rally for the entirety of a week. So that's a pretty strong looking week. And on the back of that steady rally, we then get a situation where the move continues. Very early on Monday morning. And that pushes the move onwards. The move is now increasing in volume. We're increasing in range as well. And that's quite important. We're starting seeing ranges in gold, particularly the peak that we saw yesterday, getting up to levels that we saw in mid-March, where we were comfortably touching on 700-800 ticks on a daily basis. And this then changes the perspective. You can see here, this is a reasonably steady move up that then starts to get wider rotations. This is your crescendo of the move. This is people chasing to get in. That typically is an indication of the end of move, but isn't a reason to just sell it into highs. This could go and go. So you don't want to be assuming that you pick the high of the crescendo. You don't know where that is until it turns. But this is where the weaker hands start coming in. If you've bought it on this move up here, how confident are you when this starts to pull back? I'm going to guess less so. You're already 1,500 ticks away from where you could have bought it a week earlier. And what we then get is this squeeze of long positioning and that washout that we saw. So, let's go and have a little look at some of the price action patterns in that, the psychology behind the move, and then the move itself. Most of the breaks higher in this move all came in the middle of the night. And we saw this reasonably similar pattern. So this is what I mean by the price action pattern, in that you're seeing these spikes up in the middle of night, drift back down, and then drift on up. So chasing that first explosive move creates a bit of FOMO. This is people thinking, oh, I need to get in because I'm going to miss it. We then get the market back off on them and people then start to steadily buy. And we see it again, middle of last week, spike up, pull back and bid up. We see it again to a slightly marginal point at the beginning of this week, spike up, pull back, bid up. And then again, you get a crescendo in the overnight session, pull back and bid up again. And once more, and the important bit here in those patterns is noticing change. For each of these, there is a pullback, steady pullback, and bid up. Here, we don't see it. So this was going yesterday morning. Spike, middle of the night, that was around about 4 o'clock in the morning. Sorry, 2 o'clock in the morning. Pullback, and rather than start on a steady move up, you get an accelerated drop. There's your change. This is now changing people's perspective and starting to indicate we could be seeing something slightly different. So what's the psychology of this move now? And this is often the case as you get to record highs. That to start with, people's thought process in this move is buy it as it comes back. So steady buying around here, and then you start seeing steady buying from previous highs and onwards. The pullbacks start getting shallower. People start then, and this is basically people pushing their bids higher up. They don't want to let it pull back too far, or they fear that putting the bids lower, they won't get them. So bids start moving up, creating shallower pullbacks. And then we start to get a more accelerated move up. And this is then what starts bringing more and more shorter time frame participants in. This move up are the stronger positions. If you were in here and say you bought this pullback here and you've weathered this move up, you're in quite a strong position now. You don't need to rush for the exits. You're on side. You sat through the steady move up. You're thinking about where do you get out of this? Or how far back is this going to come before you're going to give up? Main target for many of these will have been the record high, or at least the break. Once it breaks in the overnight, this has taken away the chance for most people to actually get on that break, so they miss out, which then brings in buying higher, buying that pullback just above 25.7. And once again, overnight, people miss out on the chance of buying through highs if you're not holding overnight. So you get more of the day trader type people coming in here, chasing this move up. And yeah, this is all a case of people getting into this mindset because of the recent hype that we're going to 2000. And if you're not in, you're going to miss out. And so everyone is only looking at one thing. They're all seeing it move up here. You're now only 300 ticks shy of 2000, and everyone starts to want to be on that move. That's what sucks people in. And that's what creates, rather than this steady move up, pull back, continue, creates this much wider range up. Again, this is another overnight session, that puts in nearly a 400 tick range. Bigger than any of the previous days. So we then start to see the first drop. Tipping point, if you've been long, you've seen this acceleration and pullback and finding new buyers, that's going to be the point that a lot of people are going to give up on this, 25.7. So you now know that there's going to be a lot of skewed positions and also a lot of people who are likely to give up below 25.7. That's important. And that's now your chance for the exit, or to play for a short, I should say. What we end up with in the run up to that as well, and so these trades aren't just as simple as wait for it to get there, sell it. This is a case of, this is the first drop, the first washout. This gives you some information about how this may play out. So the nature of this move can often be similar to this. You see steady drop, flush, and you actually get a second flush here. But after this, the buying action comes back. The dip buying from around about 25.7, just here, comes back. And people start to find some support. We get a test down again to the same level, and buyers come back in and push us up again, back into this range. Good news if you're a buyer. The bad news is, having tested down again, we should be finding a move up. And the lack of buyers coming in here is preventing that happening. So what this is showing you is that whilst, yes, buyers are happy to buy here, they don't want to pay higher prices anymore. Now they're vulnerable to a rollover. In terms of your execution on this, we get a drop here out of this little range or out of the above range. That gives you the point to want to get in. That's around about 27.5. That's your trigger. Once that breaks, the chance of you reaching these lows is pretty high because there's nothing in between here and here to stop you. And once you reach those lows, because that was that significant hourly level, this is where we can start seeing the larger participants exit. And that then is what creates this steady drop. It's quick and has sort of a very sort of steady rhythmic rotation down to start with. As that accelerates towards the low, in particular between around about 08 and 01, that's your indication of the end of move. That's the exhaustion down. Next week, we'll go and look at the order flow and the way this trades, and in particular, the reversal at 04.3 and what happened there. Someone trying to keep the move down and then the move reversing. So where the opportunities were, how the order flow looked on the break, and then also at the end of the move. So you get a sense of not just where you want to be in, things to consider on the move, and also where you want to get out. So watch out for that next week. I'll be chatting that one through then. Until then though, guys, have a very good rest of your day's trading. I won't be on later on today. It is the Fed, so go watch the debrief from yesterday. I put a blog out on it yesterday as well.